If your purchase order says Incoterms, FOB, and you are shipping your goods inside a standard 20-foot or 40-foot ocean container, you are making a massive legal mistake. You might think you are following standard industry practice, but you are actually creating a massive gap in your insurance coverage that could cost you your entire business. Welcome back. Today we are talking about the most misused 3 letters in global trade, FOB, free, on board. Almost every importer and exporter uses FOB. It is the default setting for manufacturing in Asia and exporting to the West. The buyer pays for the ocean freight and the seller pays to get the goods onto the ship. It sounds simple, fair, and effective. But here is the devastating reality. The International Chamber of Commerce, the creators of Incoterms, explicitly stated that FOB must never be used for containerized cargo. It is designed strictly for bulk and break bulk cargo, like pouring grain into a hold or pumping oil into a tanker. Why? Because of the transfer of risk. Under FOB, the exact moment the legal risk transfers from the seller to the buyer is when the goods are safely loaded on board the vessel. If the goods are damaged before they touch the deck of the ship, it is the seller's financial loss. If they are damaged after, it is the buyer's loss. Now think about how modern container shipping actually works. If you are a manufacturer, you do not drive your truck directly up to the side of the ocean vessel and hand the boxes to the captain. You load the goods into a steel container at your factory, seal the doors, and drop that container off at a busy port terminal yard. That container might sit in the terminal stack for 3, 5, or even 10 days before the ship actually arrives. Here is the trap. Who is legally responsible for that container while it is sitting in the terminal? Under FOB, the seller is still responsible because the goods are not on board the vessel yet. The seller has zero physical control over that port terminal. They cannot protect the goods. If a terminal crane accidentally drops your container, or if a fire breaks out in the port yard, or if a flood destroys the stack, who pays? The buyer's marine insurance will instantly reject the claim. They will point to the contract and say, the goods never made it on board the ship, so the risk never transferred to you. Go ask the seller for your money back. And the seller's local transit insurance will also reject the claim. They will say, our coverage ended when the truck dropped the container at the port gate. We do not cover port terminal operations. You are left in a legal black hole. Millions of dollars of cargo destroyed, and neither insurance company will pay out because you used the wrong Incoterm. The solution is incredibly simple, but the industry is too stubborn to change. You must stop using FOB and switch to FCA, free carrier. Under FCA, the risk transfers from the seller to the buyer the exact moment the container is handed over to the carrier at the terminal gate. It completely closes the insurance gap. The seller's responsibility ends when they deliver the container, and the buyer's marine insurance instantly kicks in to cover the goods while they wait in the terminal yard. It does not change who pays for what. The costs remain exactly the same. It only changes where the legal liability shifts, protecting both parties from a catastrophic loss. Are you currently shipping ocean containers under FOB terms? Check your commercial invoices and your insurance policies today. If you need help convincing your suppliers or buyers to switch from FOB to FCA, drop a comment below and let's get your contracts updated. Thanks for watching. Protect your cargo, use the right Incoterm, and see you in the next video.